Hey everybody, as a tax attorney and tax professor, I often get different types of questions relating to the basic tax formula and being able to understand the difference between a deduction and a credit and how it all relates to your taxable income. Now, I get these questions from students as they're first starting to learn about taxation. I get these questions from clients. I get these questions just whenever I'm out and they find out that I'm a tax attorney. And what I want to do is I want to provide you with a video that kind of walks you through this process from a beginner's perspective, so that way you can see what the tax formula is, and maybe you can start to understand, hey, these are where I really want to focus on for tax deductions, and maybe these itemized deductions aren't really doing me much. And then we can also take a look at, hey, we love tax credits, right? And we'll understand why we love tax credits so much. So in this video, here's the way we're going to structure it. We're first going to look at the basic tax formula, and next to the formula, like for gross income, I put a lot of different types of transactions that would be included in gross income. Then what we do is we go over and we look at the different types of adjustments, which are a form of deductions. That gets us to AGI. So I'm going to list these different types of transactions that you may see in each category. The purpose is to help us understand the foundation so we can eventually move into tax planning to help you minimize your tax liability legally, right? To make you do this legally so that way you're not going to have that tax liability or have to deal with the repercussions of not doing something legally, or even if it's not illegal, having penalties from the IRS because you didn't do it correctly. So we're going to start out with that tax formula. And then what I'm going to do is I'm going to show you some different tax rates and say, hey, if you take a deduction, here's how much you would save versus if you take a credit. So we're going to look at that. We're going to compare at different tax rates so you can see the value of the credit versus the deduction. And then finally, I'm going to walk through an example so you can see it actually applied in a real case scenario. So let's go ahead, let's go take a look at that tax formula right now. So on the left-hand side of this table, we see the tax formula. This is the same formula that your CPA or tax attorney is using, or your enrolled agent, or if you're doing the taxes alone, if you're using something like TurboTax or Tax Act or whatever program you're using, this is the formula that it really applies. There's the basic formula for us. Now there's a lot that goes behind the scenes, but this is what we're dealing with. So the first thing is we have to identify all of our income. And the code, the IRS says gross income is from all sources derived. So basically any income that we get is going to be included here. Now it comes into different areas on the tax return and all that. And I'll do a video that's going to walk you through all that later on. But what we're doing is we have different examples, like wages is going to be in there. Tips. Now there is a video that I have that talks about tip income because we have new rules that deal with tip income. Some of it's not going to be taxed. Bonuses, interest, dividends, capital gains. Now some of those things are going to be taxed at different rates, right? So you might have something that's going to be taxed at the 0, 15, or 20% rate versus your ordinary rate. That's fine. We're just right now identifying gross income so you know what's included in that. Unemployment, Social Security, the taxable portion of Social Security anyways. So that is all considered gross income. So we know we're going to be paying tax on these items that are going to be here in gross income. Now what we're dealing with is the adjustments. And for some of you that have done taxes before, or maybe you know accountants, you might have heard the term above the line deductions. Well, hey, that's what our adjustments are. Okay, the adjustments are deductions. And you can see that I put it in red, and then where you have the itemized deductions, I put that in red as well, because one of the primary purposes of this goal is to tell us the difference between deductions and credits. So I wanted to make sure you were aware of the different types of deductions that exist. Now, the adjustment, we sometimes call that the above the line deduction, right? Or we call it for AGI because it is used before we get to AGI, and it's going to be subtracted from our gross income in order for us to get to our adjusted gross income, our AGI. Now, what this means is if you have an adjustment or an above the line deduction, you get to take all these deductions, and then you still will make a decision on whether you're going to itemize or take the standard deduction. So even if you're taking the standard deduction, which about 90% of taxpayers do these days, Well, you can still take, and you should be taking, all of these above the line adjustments, all these different adjustments. And here's some of our typical adjustments. Traditional IRA contributions are going to be in there. Student loan interest is a big one. That's included in there. K through 12 educators, you have one in there, right? It's not a very big above the line deduction or adjustment, but you do have one in there. Self-employment health insurance, that's going to be in there. Self-employed retirement contributions, HSA contributions. So all those things are going to be considered adjustments. They're above the line deductions, and it's reducing our taxable income. You see, this whole formula is going to work us toward our tax liability, and then eventually how much we owe on our taxes. So we looked at gross income, and we've looked at the first level of deductions, which we call adjustments. And again, everybody gets those. Then what we do is we have our AGI, adjusted gross income. AGI is a super important term in tax because we have certain itemized deductions, and it's going to be a percentage of. So like if you have medical expenses, you're not going to be able to take that until your medical expenses are 7.5% of your AGI. So your AGI, you want to lower AGI as much as possible. So that's where those adjustments, the above the line deductions, are so important to us. Okay, so we have our AGI number. So just gross income minus our adjustments gives us our AGI. Then what we do is now we have to make a decision. We have to either take the standard deduction, like I said, 90% of people are doing that, or we take the itemized deductions. So we look at different types of deductions that we may be eligible for. Some of the more common ones are going to be things like property taxes, state income taxes, mortgage interest, right? Those are going to be some common ones that are going to be out there. Less common is going to be medical expenses, because generally you have to have a pretty high level of medical expenses to be able to deduct those, because we have that 7.5% threshold of AGI. Casualty losses, I mean, if it's a federally declared disaster area, you can have those there as well. Now, a lot of people, they don't have the itemized deductions that are going to make it worthwhile to do those, but that is another type of deduction. Now, look at, this is important for you to note. Gross income minus above the line deductions and either the standard deduction or the below the line deduction. Okay, those are all deductions. So we have our gross income and we're subtracting out deductions. That's to get to taxable income. Okay, so we'll go AGI minus our standard or itemized deductions, and we get to taxable income. But you can see how we've gone from gross income, all sources derived, and then we start chipping away at it with our deductions. That gets us to our taxable income. Now, the taxable income is basically our base that we're using. We're going to apply our tax rates to our taxable income. Okay, we're applying our tax rates to our taxable income. So you can lower your taxable income by taking out adjustments and deductions. Okay, that lowers our taxable income, which in turn will lower our tax liability, because if we have a 25% tax rate, just for simplicity, and we have $100,000 of taxable income, you see where we're lowering it. Now we're only applying that 25% up to the 100,000. Now, that's not completely accurate because we have marginal tax rates. I'm just using that as a very loose example. We'll look at something more detailed than that. Okay, after we do that, after we apply our tax rates to our taxable income, what we have is our tax liability. So now we have a tax liability. It doesn't mean that's what we owe yet, okay? That tax liability is there before we take out our good friend credits. We love credits, okay? We love credits because credits are going to reduce our tax liability dollar for dollar. And even some of them are even better because they're refundable. It'll reduce us all the way down to zero, and then we're going to get a refund. We love tax credits, right? they're better. They're going to provide a better outcome than deductions. Now, we don't just get to say, hey, I don't want to call this one a deduction. I want to call it a tax credit. We're limited to what a tax credit is. And here's some of them. The American Opportunity Tax Credit. That one's a refundable credit, or at least a partially refundable credit. We have our Lifetime Learning Credit, our Child and Dependent Care Credit, our Child Tax Credit, refundable, our Earned Income Tax Credit, refundable, and our energy credits, and our Savers Credit. Everybody always forgets about the Poor Savers Credit, but it's still there and it's still good. Okay? Now, 3 of those are going to be the refundable ones, which means it might result in you getting a refund. The other ones are going to help us bring our tax liability down to 0. Okay, so if we had a $15,000 tax liability and we had a $4,000 American Opportunity Tax Credit, our tax liability is not $15,000 anymore. We subtract out $4,000. Now our tax liability is $11,000. You see, the deduction reduces our taxable income, right? Or it reduces our taxable income. The credit reduces our tax liability directly. Okay, and that's where we're going to get to the taxes owed or tax refund. Of course, we'd also look at things like how much has already been withheld from our salary. Do we make any prepayments? Those things are going to be included in there after credits. So we still have another little aspect to it. But this is our basic tax formula. This is what we're using for tax planning and all kinds of things. So let's go ahead and let's look at the difference between our deduction and our tax credit based on our different possible tax rates. What if we're a 12% tax rate? What if we're a 37% tax rate, right? So let's go ahead and take a look at that right now. So our tax credit versus deduction. This is our different tax rates. And what you look at is when you're looking at the tax rate, our left hand over here, we're going to have 12%, 12%, 22%, 22%, 37%. So we're assuming that this taxpayer is either going to be in the 12, 22, or 37% bracket. Then when you look at the tax action, what I'm saying is they have either a $1,000 deduction or a $1,000 credit. So if it's in green, it's a credit, but you can see each of them will have the tax rates at 12%, 22%, or 37%. One of them is going to be blue, is going to be the deduction. Green is going to be our credit. Now, if we have a $1,000 deduction and we're at the 12% rate, then what's going to happen is the amount of money that we're going to save is 1,000 times 12%. That's $120. Okay, we're going to get a benefit of $120 on this because it's reducing our taxable income. And our taxable income is going to be taxed at the rate of 12%. So that's what we get. Now, if we look at the green row over here, we have our 12% times the credit. Okay, so now what we're looking at is not $120, but we're looking at $1,000. Because remember, a tax credit is dollar for dollar against our tax liability. You have a $1,000 credit, you reduce your tax liability by a $1,000 credit. A deduction reduces our taxable income, whether it's above the line or below the line. It reduces our taxable income. Okay, the credit is reducing our tax liability. So if you're in the 12%, you have a client who's in a 12% tax bracket, or you yourself are in the 12% tax bracket, if it's considered a deduction, you benefit by $120. If it's a credit, you benefit by the $1,000. That's $880 difference. The credit is worth $880 more than the deduction. Same thing, if we go to 22%, the 22% with the $1,000 deduction saves you $220. Okay, that's what you're going to be saving with this deduction. But if you have a tax credit of $1,000, you get a full $1,000, right? Because you're going to knock off your taxable income, your taxable liability dollar for dollar. So the difference between the $220 or the $1,000 for a taxpayer who's at the 22% rate is going to be $780. And then if we go over to the 37%, we're going to see that a 37% taxpayer who's in the top bracket of 37% has a $1,000 deduction. That's going to benefit them $370. But if they have the credit, they get the full $1,000. So there's a difference of $630. So even though we see that the savings may have differed between the two, because of 37%, if you're at 37%, a deduction is still pretty good, it's not as good as a credit. The credit is better than our deduction. Now what I want to do is I want to conclude this video by walking through an example so you can see how this applies. It's just going to be a short example. We'll do that and we'll end this video. Hopefully you're going to have the skill set to understand the difference between credits and credits and deductions, and we'll be able to start working on the tax planning part. So in our problem, we have Tabitha, who's a full-time college student. She's paying $4,000 in tuition. If she claimed a deduction, she might save around $480. We're assuming she's in the 12% tax bracket. Okay, so $4,000 times 12%, it means she's going to be benefiting by about $480 by being able to take a deduction for that at the 12% rate. But the American Opportunity Tax Credit allows us to take a deduction up to $2,500 with $1,000 being refundable. So because we're able to take the full tax credit in this situation, or at least based on these small facts that we're presented with, we're presuming we're taking the full $2,500 with $1,000 refundable. That's far better than that $480 we would have gotten as a deduction, right? And we might even be getting a refund because that's at $1,000 refundable. So if our tax liability were brought all the way down to zero and we still had, say, $1,300 left of our credit because we only had to use $1,200 of it, $1,000 of that can now be refunded to us, so we walk away with some money versus only getting a benefit of $480. So hopefully you can see here that the tax liability is going to be significantly lower if you're taking the credit versus if you're taking the deduction. All right, so that is our basics of our tax credit versus our deduction. Now go ahead and subscribe to my channel so that way you keep up to date with these different tips that we're going through. I'm also going to be doing some videos that are going to relate to the different forms that we're looking at. Our 1040, I'm going to go line by line with that. That one's going to come out in early January. I also will be doing in the next day or two a video that's going to be focusing on different techniques for tax planning. So basic techniques. What are we trying to do? Are we trying to defer gain recognition? Are we trying to accelerate deductions? We're going to walk through that process. That's the foundation of what every tax planner is doing. All right. Thank you for watching the video.